If you're in your 30s or 40s, you've likely started planning for retirement. But if all of your money is stuffed into traditional 401ks and IRAs that get taxed when you retire, you might be in for a rude awakening from everybody's favorite uncle, Uncle Sam, when you transition into your golden years, and you might be hit with a very unexpected tax bill, which could shock you. Now, you might be sitting there thinking, but I've been putting money into my 401k and IRA for like years. Isn't that the best way to save for retirement? I mean, that's what my parents did. Unfortunately, what worked 40 years ago for your parents doesn't apply in today's world. In this video, we're going to dive into the why and the how. It's so important to start to transition your money out of taxable strategies and into things that grow tax-free. 9 years of experience here, working in the industry. I've helped over 700 clients. I've trained thousands of licensed agents across the country, and I've been producing educational content on social media for over 3 years. I promise you I've been met with just about every single philosophy and viewpoint on retiring tax-free. Today, we're going to uncover the why and the how. First, let's talk about the why. Why, in my opinion, is it so important to start to transition your money into accounts that grow tax-free? For starters, if you haven't read the book or at least watched the movie, The Power of Zero by David McKnight, I highly recommend you do. In fact, if you click the link in the description below, give me your information, I'll shoot you the movie over to your email free, completely complimentary. It's that important, I think, that you should watch it. This came out in 2018. The whole premise is about why it's so important to focus on retiring tax-free and what David calls the 0% tax bracket. He shares shocking statistics about really an age-old truth that he's trying to combat that millions of Americans are telling to their children, which could drastically screw all their kids over when it comes to retirement, which is to start saving money into traditional 401ks and IRAs because you will retire in a lower tax bracket. So in theory, why pay taxes now when you could pay taxes later and in theory pay less? While this did work for people retiring today because taxes have gone down significantly over the last 40 years, problem is the working generations today might not get so lucky. And with the US national debt skyrocketing, plus our underfunded liabilities of Social Security, Medicare, Medicaid, and state pensions, it's highly unlikely that taxes won't rise on the working generations today. Well, maybe your plan is to continue to defer taxes throughout retirement by not taking out money. Well, unfortunately, you're going to have to take it out at some point. It's called an RMD, or what we also call a required minimum distribution. For example, I have a client that is 73 years old that has all of her money in traditional tax-deferred retirement accounts, and she doesn't need it. She lives a very modest lifestyle, and she would much prefer to leave this $2 million that she has as an inheritance to her kids and her grandkids when she passes away. But unfortunately, if she doesn't take out her RMDs, her required minimum distributions, the government is going to heavily tax and penalize her. The RMD rule does not apply to accounts that grow tax-free. You also need to consider the two sneakiest destroyers to retirement income. And the first one is inflation. Inflation is rising prices. Even if taxes miraculously go down in the future, if all of the prices go up, you might find yourself in an even higher tax bracket just because you need to take out more income to live the same lifestyle you were living before. If you go to the Bureau of Labor Statistics website, you'll see that they have an inflation calculator that you can play around with. For example, let's say you're 30 years old, on track to retire with $1 million in your 401k. If you plug those numbers in and you work them backwards, you'll see that $1 million 30 years from now has the same buying power as $486,000 today. That is significantly less. You still have to subtract out taxes from that too. So don't you see now that you may need to take out even more money in income in retirement just to afford basic living expenses, which could bump you into a higher tax bracket? And not only will you need more money to live the same lifestyle, you have to consider sneaky destroyer number 2 of your retirement income, which is increased medical cost. There is a high chance that you're going to need even more money coming in to pay increased medical expenses in retirement. A healthy couple between the ages of 65 and 74 spends an average of $13,000 a year on healthcare. And that increases to $23,000 a year from age 75 to 84, and that increases to $40,000 a year after age 85. So if you're saving your money into traditional 401ks or IRAs, meaning you'll pay taxes in retirement, if taxes go up in the future and you need more money coming out to live the same lifestyle, can you see how you might end up in an even higher tax bracket in retirement than you are today? Now can you see why it's so important to start to shift money into accounts that grow tax-free? So now the next question is how, right? How do we do this? This is when you'd want to have a consultation with your tax professional about what it would look like to stop your contributions into traditional 401ks and IRAs and start contributing or reallocating that money into accounts that grow tax-free. But Amanda, my employer gives me a match. Should I just walk away from free money? Come on. Do you really think they give you that match because it's good for you or because it's probably good for them? I mean, it's kind of a trick question because it's somewhat kind of sort of good for both, right? Because to you, it appears to be free money. But do you really think they're giving you that money for free? Really what's happening is that match that your employer gives you is a tax deduction for the company. So essentially what they're doing is they are shifting their tax liability to you as the employee to pay later on in life when you retire when taxes could be higher. Again, this is why it's so important to consider accounts that grow tax-free. Okay, so what accounts grow tax-free? Well, first we have Roth 401ks, which are a good option if they're offered to you by your employer because it's after-tax dollars that go in, so that can grow tax-free. The downside is not every employer today offers them, and there are limits on how much you can contribute per year. Another option is a Roth IRA if you don't get a Roth 401k through work. But there are a lot of restrictions based on income, so unfortunately not everybody can have one, and there are super low contribution caps on what you can contribute per year. Another popular option you've probably heard of is called a backdoored Roth IRA, which is popular around middle income earners that make too much money to qualify and contribute new money into a Roth IRA. So what they might do is contribute into a traditional IRA, or maybe they already have money in a traditional IRA or traditional 401k that they want to convert or backdoor into a Roth IRA. The benefit is it avoids them having to pay the early withdrawal 10% penalty, but they still have to pay taxes in the year they do the conversion. And if you convert a large amount in a given year, that could drastically affect your tax bracket for that year. And we also don't know for how many more years backdoored Roth IRAs will even be allowed. The government has been threatening for many years that they're going to get rid of it. So if you're choosing this option, good luck. This is why I talk so much about a unique product that has no cap on what you can contribute per year, and there's no disqualification based on how much income you make, which is what makes them a fan favorite among some of the world's wealthiest elites, and that would be an IUL, or what we also call an Index Universal Life. An IUL in its simplest form is just a permanent life insurance policy that you can overfund the cost to own. That's going to grow a cash value component inside of it that you can borrow against for anything that you leave, no questions asked at any time in the future. There is no set cap on how much you can contribute per year, and there's no disqualification based on income or any restrictions on income like you have to deal with a Roth IRA and with the Roth 401k. You have complete control, and you can design the account to hold as much money as you want per year going into it. Oh, and the really great part, you can't lose money based on the stock market because the account comes with a 0% floor. This sounds way too good to be true. What's the downside? Well, unfortunately, you do got to get approved. The insurance companies look into your age, your health history, and your criminal background. They're essentially looking to see if you would be a risky individual to bring on board because obviously they're looking for people that actually are going to live for a very long time. And if they determine that you aren't too risky of a person to bring on board and insure, they will make an offer on an insurance policy. Now let's check out a side-by-side example between an IUL and a traditional 401k. If we're looking at a gentleman that is 40 years old, and we're just going to say that he is a standard health and he's a non-smoker, which doesn't necessarily matter on the 401k side, but it does matter on the IUL side. And let's say that he's max funding his 401k at $23,500 a year with pre-tax money. If he wants to contribute that into his IUL, it would be after-tax dollars, which would equal about $1,500 a month. He would need to get a $300,000 death benefit to be able to do this with the IUL. And the 401k doesn't come with any death benefit or life insurance, but let's just say he's getting a $5,000 match per year. Let's assume that he's earning 6.5% in interest in all years, working years and retirement years. Now, I'm sure we can all agree that it most likely would be a lot higher in both scenarios, but we're going to be conservative. On the IUL side, the cost of insurance is already deducted. That's based on his age and his health. On the 401k side, let's deduct just a 1% fee per year to give you an idea on what this expense does over time. Now, reality is most 401ks you're paying somewhere between 3 to 5% in fees per year. I know many of you are going to argue with me on that, so I linked a video and an article below that will explain this in more detail for you, but we'll just start with 1% per year just to be conservative. If they retire by age 65, in retirement on the IUL side, no taxes are owed, but on the 401k side, if it's traditional, you do owe taxes. Let's just be conservative and say 25% per year in taxes. As we've discussed earlier, it could be significantly higher than this, but let's play on the conservative side. In income in retirement on the IUL side, that's going to get you about $8,600 a month tax-free or $104,000 a year. Compared to on the 401k side, $7,400 a month after taxes or just $88,000 a year. That's a big difference. That big difference is mainly because of taxes. So now let's compare an IUL to a Roth 401k. So we're going to use the same example, male, 40 years old, that is standard health, and he is a non-smoker, which again doesn't really matter on the Roth 401k side. And let's say that he's still max funding the Roth 401k with $23,500 a year, and that's after-tax dollars. So to do apples to apples, we will show $23,500 a year going into the IUL. He would need to now get a $400,000 death benefit to hold that on the IUL side. And again, the Roth IRA doesn't come with any life insurance, but let's assume he's still getting that same $5,000 match per year. Let's assume that in all years, we're still earning that same 6.5% rate of return in our working and our retirement years. And with the IUL, the cost of insurance is already deducted. Again, that's based on his age and his health. And with the Roth 401k, we're going to stick with that just 1% fee per year. Now, again, if they retire at age 65, at this point, both accounts are growing tax-free, so no taxes are owed. But let's see what the difference is in income. With an IUL, they're estimated to bring in $11,480 a month after taxes or $137,000 a year. Compared to the Roth 401k, we're looking at $9,860 a month or $118,000 a year. Again, big difference. As you can see, there's still a really big difference between the two. And the main reason is because with IULs, you get a unique feature that's unmatched by these traditional retirement accounts, which is a loan feature where you have the ability to actually borrow against your cash value without depleting it, which doesn't interrupt your compound interest, which all in short just basically means you can stretch the money. You can get a lot more out of it because you're still growing and earning interest on money inside the account like it never left. With either option that you choose, the important takeaway here is that you just consider starting to diversify some money into accounts that grow tax-free. Please make sure that you consult with a tax professional and a financial professional before you do anything. And if you'd like to learn more about how IULs and other tax-free accounts work, you can check out the 2 videos that I have linked here. And I'll see you next week on YouTube.